Welcome to the deep dive. Today, we're really getting into the nuts and bolts of auto loans and security. This is specifically for you folks in the U.S. thinking about financing a car.
Yeah, our mission here is to kind of break it all down, make
All
it
right.
clear how these loans work, what the security aspects mean, so you can feel, confident making those big decisions.
Exactly. And let's start with why this is so important. Take David, recent college grad, right? Lands a job, needs wheels.
Classic situation.
Totally. Finds a car, but the first loan offer. Oof. Interest rate was pretty high, mostly because, well, he didn't have much credit history yet.
Right, just starting out.
But here's the kicker. His parents agreed to co-sign. And that one thing, having that extra security, boom, got him a much better interest rate.
Saved him real money.
Oh, absolutely. We're talking potentially thousands over the life of that loan. It just shows how understanding security, like co-signing, directly impacts your wallet.
David's story is a perfect lead-in. So let's back up. What exactly is an auto loan, fundamentally?
Okay, yeah, the basics. At its heart, it's borrowed money specifically for a car. And the key thing is it's a secured loan,
Secured meaning.
meaning the car itself acts as collateral. Think of it this way. If you stop paying, the lender can actually take the car back. That's their security, their guarantee.
Gotcha. And these loans have a set time frame, right? Like a payment schedule.
Yep, usually somewhere between 36 months, so 3 years, up to maybe 72 months, 6 years, sometimes even longer these days.
And the interest rate, the cost of borrowing that varies quite a bit.
It really does. Big factors are your credit score, basically, your track record with debt, and also how long the loan term is. Shorter term often means a lower rate, but higher payments.
Makes sense. What else do lenders look at when you apply?
Well, besides the credit score, the down payment is huge. How much cash you put up front, and more down usually means less risk for them, maybe better terms for you.
Right, less to borrow.
Exactly. The loan term length, like we said, even the car itself, its age, its value, that plays a role too.
Oh, and just for context, the average rate for a new car loan has been floating around 6.35% recently, but that can change, with the market.
That average gives a good benchmark. And here's a really solid tip we always give. Shop for your loan before you seriously shop for the car.
Oh, that's crucial. Why?
Getting pre-approved tells you exactly how much you can realistically borrow and at what rate. It gives you, serious negotiating power at the dealership. You know your budget, you know your rate, you're focused on the car's price, not just a monthly payment figure they throw at you.
That's smart. Puts you in the driver's seat, financially speaking. Okay, so David's parents co-signed. Let's unpack that. What does being a co-signer actually involve?
Okay, so a cosigner is someone, usually with good credit, who essentially vouches for you on the loan. They agree that if you, the main borrower, can't make the payments for whatever reason,
I have to pay.
they are legally obligated to pay the loan, the whole thing. Wow. So it's not just like a character reference. It's a serious legal and financial commitment. They're on the hook for the entire amount.
Precisely. It's a big deal. And that's why having a co-signer with strong credit can really help someone get approved, especially if their own credit is still being built or isn't quite top tier. The lender sees less risk because there's that backup.
Okay, but what about the cosigner themselves? What should they know?
Super important point for anyone thinking of co-signing that loan. It shows up on your credit report too. And if the main borrower misses payments or defaults,
It hits the cosigner's credit?
absolutely.
Yeah.
And they're fully responsible for paying off the entire debt. It can definitely impact their own ability to borrow money later.
Something to think very carefully about before agreeing.
Definitely. But for the person getting the loan, the benefits can be significant. Like David, you often get lower interest rates. That saves money.
Big time.
Your chances of getting approved in the first place go way up. You might get offered better terms overall. And it's a great way to build your own credit history if you make all the payments on time.
Let's put some numbers on that. Say someone, let's call her Emily, needs a $25,000 loan. On her own, maybe she qualifies for, say, 8.5% interest.
Okay.
Her payment might be around $515 a month. But if she gets a cosigner with great credit, maybe that rate drops to 4.5%.
Big difference.
Huge. Now her payment is closer to $465. Over 5 years, that's what, like $50 a month difference? It adds up to around $3,000 saved just in interest.
Yeah, that's real money back in Emily's pocket just because she had that cosigner providing security. It really illustrates the value.
Right, definitely. Okay, now let's shift to the less pleasant side. What happens if things go wrong, if you just can't make those payments? Repossession.
All right. It's a tough topic, but essential to understand. Repossession is basically when the lender exercises their right to take the vehicle back because payments have stopped.
And it can happen faster than people think, right? Not necessarily after months of missed payments.
That's a critical point. Depending on your loan agreement and state laws, repossession can potentially happen after just one missed payment. Lenders don't always wait.
Wow. And the consequences are pretty severe, beyond just losing the car.
Oh, very severe. First, you lose your transportation, obviously, but it also does major damage to your credit score.
Mm.
A repo stays on your report for years, making it much harder and more expensive to get credit later for anything, not just cars.
And isn't there a chance you could still owe money after they take the car?
Yes, absolutely. That's called the deficiency balance. The lender sells the repossessed car, usually at auction. If the sale price doesn't cover the remaining loan balance, plus all the fees associated with the repo and sale,
You're still liable for the difference.
you are still legally responsible for paying that leftover amount. So you've lost the car and you still owe money. It's a really difficult situation.
Okay, so clearly something everyone wants to avoid. What are the practical steps to prevent repossession?
Number one, obviously, is making payments on time, every time. Set up reminders, auto pay, whatever works for you. But if you see trouble coming, maybe a job loss, unexpected medical bills, the absolute key is communication.
Talk to the lender before you miss a payment.
Yes, immediately. Explain the situation honestly. Don't just ignore it. They might have options, like a temporary forbearance or adjusting your payment plan. It's not guaranteed, but you have to ask.
What about refinancing? Could that help?
It potentially could, if your financial situation allows. Refinancing might get you a lower interest rate or a longer term, which could lower your monthly payment. But you usually need decent credit to qualify for refinancing.
Okay. Anything else?
Keep your car insurance up to date. That's usually required by the loan anyway, and it protects you if the car is damaged or totaled, preventing you from owing on a car you can't even drive. And, generally keeping the car in good shape doesn't hurt either.
We heard about a guy, Tom, who lost his job. Facing repossession, instead of hiding, he called his lender right away.
Smart move.
Yeah, explained everything, worked out a temporary reduced payment plan while he looked for work. He even did some gig work to make ends meet, found a new job, got back on track, and kept his car.
That's a great example. Proactive communication really can make a difference. Lenders often prefer working something out rather than going through the hassle and expense of repossession.
Good point. Okay, so when lenders are deciding whether to approve a loan in the first place, besides credit score, what else are they looking at? You mentioned something earlier, DTI.
Right, DTI.
Yeah.
Debt to income ratio. It's a really important metric for lenders.
What exactly does it measure? Why do they care so much?
It measures how much of your gross monthly income, that's your income, before taxes goes towards paying your monthly debt obligations. Lenders use it to see how much debt you're already carrying and whether you can realistically handle another payment, like for a car.
Is there like a target DTI they look for?
Generally, yeah. Many lenders prefer a DTI below 43%. Lower is usually better, showing you have more breathing room in your budget. A high DTI signals higher risk.
Okay, so how do I calculate my own DTI? Is it complicated?
No, it's pretty straightforward. First, add up all your required monthly debt payments. Think mortgage or rent, minimum credit card payments, student loans, personal loans, any other installment debts. And include the estimated payment for the car loan you're considering.
Okay, total monthly debt payments. Got it. Then what?
Then, you divide that total monthly debt number by your gross monthly income again, income before any deductions.
Divide total debt by gross income.
And finally, multiply that result by 100 to get the percentage.
Right. So, quick example. If my total monthly debts, including the potential car payment, are $2,000, and my gross monthly income is $5,000,
You do $2,000 divided by $5,000, which is 0.4.
multiply by 100, 40%. So my DTI would be 40%.
Exactly. And remember, it's crucial to include everything, rent, mortgage, credit cards, everything, not just the car loan, to get an accurate picture for both you and the lender.
Makes sense. Gives a real snapshot of your financial obligations. Okay, we've covered a lot of ground. Let's maybe pull together some key takeaways, some expert tips for someone going through this process.
Sure. Top tips for getting an auto loan. 1. Save for a down payment. The bigger the better. It reduces the loan amount, might get you a better rate.
Less borrowed, less interest paid. Good start.
2. Consider shorter loan terms if you can manage the payments. Yes, the monthly payment is higher, but you pay way less interest overall and own the car sooner.
3. Shop around. We can't stress this enough. Compare rates from banks, credit unions, online lenders before you go to the dealership. Get pre-approved.
4. Understand all the fees. Ask about origination fees, doc fees, anything beyond the interest rate. Know the total
Read
costs.
the fine print, basically.
Exactly, which leads to 5. Read the loan agreement carefully before signing. Ask questions if anything's unclear. Don't get rushed.
And 6.
Keep good insurance coverage. It's usually required, and it protects your investment and satisfies the lender.
All solid, practical advice. Now, what about common myths? Things people often get wrong about auto loans.
Yeah, let's bust a few. Myth number 1, you need perfect credit. Not true.
Oh.
Many lenders work with various credit scores. Perfect credit gets the best rates, sure, but you can still often get a loan with less than perfect credit, just maybe at a higher rate.
Okay, good to know. Myth number 2. Longer loans are always better because the payment is lower.
We touched on this. Lower payment, yes, but you pay significantly more interest over, say, 72 or 84 months compared to 48 or 60. Shorter terms save money long term.
Right. And myth 3. Dealer financing is always the best deal.
Convenient? Maybe. Always best. Definitely not. You absolutely should compare their offer with your pre-approval from a bank or credit union. You can save a lot by shopping around. Don't assume the dealer is giving you the lowest rate possible.
Okay, let's tackle some specific questions people often ask.
Sounds good.
A big one. How much car can I really afford?
The $1 million or maybe $20,000 question. A common guideline is that your total car costs, payment, insurance, maybe gas factored in, shouldn't exceed 15%, maybe 20% max of your gross monthly income.
So like that DTI calculation, it's about fitting it into the bigger picture?
Exactly. That 15–20% is just a starting point. You have to look at your entire budget. Other debts, savings goals, don't let a car payment squeeze out everything else.
Makes sense. Okay, next question. Should I get a cosigner?
You should seriously consider it if you have very little credit history. Maybe you're young or new to credit, or if your score isn't strong enough to get good terms alone. A creditworthy cosigner can unlock better rates and improve approval odds.
But remember the risks for the cosigner we discussed.
Absolutely. It requires trust and open communication.
Final common question. Uh-oh, what if I realize I can't make my next payment?
The answer is always the same. Contact your lender immediately, before the due date is possible. Explain the situation. Ask about options. Ignoring it is the worst thing you can do. Communication is key to potentially avoiding default and repossession.
Okay, so wrapping this all up, let's give people a clear action plan. Steps to take before getting that auto loan.
Okay, step by step. 1, check your credit score. Know where you stand. Sites like annualcreditreport.com let you check for free.
2, calculate your DTI. See how a car payment fits your budget realistically.
3, save for that down payment. Even a small one helps.
4, get pre-approved for a loan from your bank or credit union before car shopping.
5, shop around for the best rates and terms from multiple lenders. Compare offers.
6, read everything carefully. Understand the loan agreement fully before signing. Ask questions.
And 7, make sure you have adequate car insurance lined up.
Great checklist. And there are tools online to help with this, right?
Oh yeah, tons. Auto loan calculators, DTI calculators, free credit score checkers, insurance comparison sites, vehicle value guides like Kelley Blue Book or NEDA guides. Use them. They're widely available.
So the bottom line seems to be knowledge is power here.
Absolutely. Understanding how auto loans work, the security involved, your own financial picture, that's what lets you make smart choices, avoid pitfalls, and get a deal that actually works for you long term. Do your homework.
Well, this has been a really thorough exploration of auto loans. Hopefully you all feel much more equipped now. And join us next time on the Deep Dive, where we'll be tackling another crucial piece of car ownership, car insurance, understanding coverage and costs.
Yeah, definitely tune in for that. And if you found today's discussion helpful, please share it with friends or family who might be looking at buying a car. And of course, subscribe to the Deep Dive wherever you get your podcasts so you don't miss out.
You can also find us on social media for other financial tidbits. Until our next deep dive, keep exploring, keep learning, and keep building that solid financial future.